Hey everyone, this is Richard Yi from the Austrian perspective. Today is June 2nd, 2012. Yesterday, the market was hit by many negative news coming out worldwide, and major indexes were heavily affected, with most of them down well beyond 2%. And at the same time, gold was up 4% as investors anticipate that the Fed is very likely to launch another round of quantitative easing as economic data don't look that good. But what I found was way more interesting than the activity in the market yesterday was that 2 weeks ago, gold price was actually in backwardation. Well, that hasn't happened since December 2008. Right? First, let me explain what backwardation is. Well, backwardation is basically the condition that in the futures market, a futures contract is trading lower than the spot price. Well, let me elaborate on that. So normally in the futures market, commodities are in contango, right? That's the condition in which futures price is higher than the spot price. Well, I mean, take say I don't know, take steel for example. If you're buying steel, those blocks, if you're paying say $100 per ton at a spot price, it's likely that you gotta pay say $120 per ton, of steel delivered 6 months from now. Why is that? Because there's storage cost. So why would backwardation happen, which is future price lower than the present price, right? Well, we can make another example. Say we're in the market for wheat, right? And we are in say 200 years ago, in which wheat were produced only seasonally, while consumption was spread pretty much all over the year. So we have a condition in which at the season that the wheat is produced, we have a lot of inventory, and right before the next harvest, we got a really low wheat inventory, right? So you have like a inventory curve that goes something like that, right? So immediately, if you want to get wheat, that's pretty close to the next harvest, the price is gonna be really expensive because there's not no that much wheat in the warehouse, and if you really want it, you gotta pay a really high price, right? That makes sense. And everyone knows that in 1 month, 2 months, you know the when the next harvest hits, you're gonna have a lot of wheat inventory, and the price of wheat will be driven down. So the people who are likely to, who they have the money to wait, they have the time to wait, they will wait, and then that's why the price of wheat is backwardation, right? Because in the future there's more inventory. So in general, a backwardation signifies that there's a shortage of commodity in the present. However, if we try to use the same conclusion on gold, then it seems very strange because gold doesn't have like floating inventory like wheat, right? Because it's produced year round, and there's really not that much gold consumption, so the inventory won't change as much, right? So why would it be less expensive to buy gold in the future than buying gold right now? Well, first of all, if the present price is higher than the future price, then definitely that means there's a more demand for gold in the present, right? And that can be verified as global central banks, they piling up their gold reserves, although that is still considered a tiny fraction of their total reserves. Sure, central banks buying gold has the effect of pushing up gold price, but that doesn't explain why there's backwardation, right? I mean, central banks can well buy gold contracts with 6 months or 8 months or 10 months delivery, but therefore, gold price should move altogether and not just in backwardation. So a few days ago, I read an explanation that I consider is pretty. So a few days ago, I read an explanation that I consider to be pretty interesting. So here's the main idea, right? Consider you're a gold buyer, you're trying to buy gold, right? You can either buy it right now at a spot price or buy now at a future price and receive a future delivery. For the case of buying at a spot price, it's pretty easy to understand because basically you're just giving your money to the seller and the seller gives you his gold, right? Both trade, both happy. But buying with a futures contract is a little bit different. Essentially, what you're doing with a futures contract is that you and the seller have negotiated a date and a specified price to trade a certain commodity, right? In this case, gold. So you and the seller have negotiated a price and a date, okay, to trade the gold. Well, what if in reality, as countries worldwide, they accumulate too much debt, right? And their revenue can't even pay off the interest. So the world is in a serious debt crisis. What if that happens, right? What's going to happen to the value of paper money? Well, the paper money is going to collapse because the too much money printing to service the debt, and then that's another way of defaulting. The paper money is going to collapse. Okay, well now we look back to the futures contract, right? I mean, the seller, according to the futures contract, still has to accept your paper money, and you still have to, according to the contract, you have to buy the gold, right? Then in a sense, the seller of the gold is in a disadvantage, right? Because if really the debt just explodes and the paper money collapsed, right? He's in a loss, right? He will actually getting a whole bunch of worthless paper and give you the real gold. And assume right now you haven't made a contract yet, right? As a buyer, this situation if paper loses too much value, gold seller will be in a disadvantage. And at that moment, you will start to doubt if the gold holder will actually honor the gold contract, right? He will actually sell you his gold. Well, if this happens and you know that the paper money is going to lose value pretty fast, what are you going to do? Well, you're going to buy gold right now, right? Because only in the present market you can trade gold for money immediately, and in the futures market there's a risk of default. So in that case, a lot of people rush to buy gold right now, and that's why gold in backwardation, right? Because nobody's buying in the future, or little buying in the future. So according to this explanation, really the root of the problem is that global governments are accumulating too much debt. This explanation might be correct, and at the same time it might be not correct, but I think it's very interesting. And aside from gold futures backwardation, I think the global economy is really in risk of slipping back into another recession, right? Because we have so many economic indicators turning negative, be it Chinese PMI contracting, or U.S. unemployment numbers takes off in the first time in 9 months, I guess, and also the problem in Europe. Who knows what's going on, right? So it's really important to protect your wealth in such troubling time because the equity market is not likely to perform very well as global economy slips back into recession. So I mean, it's really very important to have a portion of your wealth stored as hard as that really goes against inflation. So at least some of your wealth is protected. And I guess that's it for today. Thank you for watching. I'll be blogging again soon. Take care, guys. Bye.